There's a couple I want you to think about. Both worked their whole careers. Decent jobs, nothing flashy. They did everything right, maxed out the 401k every year, lived below their means, watched the balance grow. By the time they retired, they had somewhere around $900,000 sitting in that account. They felt set. And for a few years, they were fine. Then one of them passed away. What happened next wasn't just grief. It was a financial gut punch nobody had warned them about. The surviving spouse, let's say it's the wife, still had most of the same expenses. The mortgage was the same. The utilities were the same. But her Social Security income dropped because she could only keep one benefit, not both. And her tax filing status. It flipped from married filing jointly to single. That one change, just the filing status, nearly doubled her effective tax rate on the same pool of money. She hadn't spent more. She hadn't made more. She was just alone now, and suddenly the IRS was taking a much bigger cut. This is what people call the widow's tax penalty. It's not dramatic. It doesn't announce itself. It just quietly shows up in the math. For years, I bought into the same idea. Defer taxes as long as you can. Let it grow. Pay later when you're in a lower bracket. It made sense on paper. I was wrong about the most important part. Deferring taxes isn't avoiding them. It's more like taking a loan from the IRS where they get to set the interest rate later. You don't know what rate they'll charge until you actually retire. And by then, you've already lost the ability to negotiate the terms. The money is sitting in a pre-tax account, and every dollar that comes out gets taxed as ordinary income. At whatever rate applies to your situation in that year, based on your filing status, your Social Security income, your required withdrawals, all of it stacked together. You spent 30 years building that account, but you don't fully control when you pay the taxes on it. That control belongs to the IRS. For most of those 30 years, that didn't feel like a problem. The balance kept climbing. You weren't touching it. But retirement changes the equation completely. Suddenly, you're not putting money in, you're pulling money out. And the rules around how much you pull out, and when, and how it interacts with everything else you're receiving. That's where people get blindsided. The advice that made sense during your working years. Defer, 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 was built for a different phase of life. It wasn't designed for the withdrawal years. And that shift from saving to spending changes everything. And nobody really sat you down and explained what happens when the two phases collide. Today, we're going to walk through exactly what that collision looks like, why it hits some people much harder than others, and what you can actually do about it. Specific moves, specific numbers, not just general concepts. I'll show you how to keep tens of thousands of dollars in your pocket instead of handing it over, because you didn't know the rules had changed. Take Robert, for instance. Retired at 65, felt pretty good about where he landed. Social Security coming in, a little pension, and about $1 million sitting in his traditional IRA. He ran the numbers. Between the standard deduction and his income sources, he figured he was comfortably in the 12% tax bracket. He thought he had this figured out. Then he turned 73. That's when the IRS sent him a message he couldn't ignore. Under the current rules, Secure Act 2.0, in effect right now, age 73 is when required minimum distributions kick in. If you were born in 1960 or later, you get until 75. But for most people retiring today, 73 is the number. And the rule is simple. The IRS tells you how much you have to pull out of that pre-tax account every year, whether you need the money or not. With $1 million in his IRA, Robert's first RMD came out to roughly $36,000. He didn't ask for it. He didn't need it to cover his bills. But it hit his tax return as ordinary income. Here's where it gets painful. Robert was already receiving about $28,000 a year from Social Security. On its own, that income wouldn't have triggered much in taxes. But the moment that $36,000 RMD landed on top of it, his combined income crossed a threshold. And once you cross that threshold, up to 85% of your Social Security benefit becomes taxable. Not 50%. 85%. He didn't have more money to spend. His lifestyle hadn't changed. But his tax bill jumped significantly because two income streams stacked on top of each other in a way nobody had walked him through. This is the so-called tax torpedo. It's not a single hit. It's multiple things. RMDs, Social Security taxation, stacking up and pushing you into a higher tax bracket you never saw coming. And it doesn't stop there. The same income that triggers the Social Security tax calculation also determines your Medicare premiums. The IRS and Medicare look at what's called your MAGI, your modified adjusted gross income, from 2 years prior. If that number crosses certain thresholds, Medicare adds a surcharge on top of your standard Part B premium. That surcharge is called IRMAA. It can run hundreds of dollars per month per person. It shows up quietly, and most people don't see it coming until the bill arrives. So you've got RMDs forcing income you didn't ask for. That income makes your Social Security taxable. That same income triggers Medicare penalties. 3 separate mechanisms, all activated by the same event, all hitting in the same year. I know it's a lot to keep straight. And I want to say this clearly, Lee. If you didn't know any of this, that's not a failure of effort on your part. The financial system in this country was built to help you accumulate money. There are decades of advice, tools, and incentives designed around the saving phase, the withdrawal phase. Nobody hands you a manual. You're expected to figure it out on your own, usually right when you can least afford to make expensive mistakes. The RMD problem is real, and it catches a lot of people off guard. But honestly, the RMD problem isn't even the most overlooked part of this equation. The part that gets almost no attention is what happens to people who go through this alone, without a spouse or after losing one, because the tax system treats them very differently, and not in a good way. I want to tell you about Sarah. Her husband passed away about 18 months before I met her. She was still sorting through everything. The estate paperwork, the accounts, the insurance claims. And somewhere in the middle of all that, a notice arrived from Medicare. Her premium was going up, significantly. Because of IRMAA, she hadn't changed anything. She was drawing from the same inherited IRA her husband had left her. Her Social Security was roughly the same, but her filing status had changed from married filing jointly to single. That one shift, just that, had pushed her into a different tax world entirely. I remember sitting across from her while she was still organizing the funeral home invoices, and the Medicare notice was just sitting there on the table next to them. That's when it became very clear to me how badly the standard planning tools fail people in her situation. The software assumes a couple. The advice assumes a couple. The whole framework assumes 2 people sharing one tax return. Half of retired women will spend a significant portion of their retirement alone. The math doesn't care about that. So let's look at the actual numbers because this is where it gets concrete. In 2026, the standard deduction for a married couple filing jointly is $32,200. For a single filer, it's $16,100, exactly half. The 22% tax bracket for a single filer tops out at $105,700. For a married couple, that same bracket runs all the way to $211,400. So a single person hits the higher tax rates at exactly half the income level of a married couple. Sarah's income hadn't dropped by half when her husband died, but her tax protection did. This is the core of the problem. A generic defer and figure it out later plan quietly erodes wealth if you're single, divorced, or widowed. The approach that works is called intentional bracket filling. It sounds fancy, but the idea is simple. Instead of letting your income happen to you in retirement, you manage it on purpose. You look at your tax bracket each year. specifically how much room you have before you hit the next threshold. And you make deliberate decisions about how much income to recognize, when to take it, and from which accounts. For a single filer, those windows are narrower. The margin between comfortable and just crossed into a higher bracket is smaller, which means the planning has to be more precise, not more complicated. Precise. You're not guessing. You look at a specific number, like that $105,700 ceiling, and you manage your income to stay under it. That might mean pulling from a Roth account instead of a traditional IRA in a particular year. It might mean timing a Roth conversion. It might mean coordinating when you claim Social Security relative to when your RMDs begin. The timing of income is the lever, not the amount you saved, not the account type alone. When the income shows up on your return, and in what form, determines how much of it you actually keep. For someone like Sarah, a plan built around her actual filing status, her actual income sources, and her actual Medicare exposure would have looked very different from the plan she and her husband had been following together. Not more complicated, just calibrated to her reality. If you're single, widowed, or divorced, or if you're married but want to make sure your spouse is protected if something happens to you. This is the kind of planning that actually matters, not general principles. Specific numbers, specific thresholds, specific timing. If that's what you're looking for, subscribe to Wes Investor. This is exactly the kind of thing we cover here, built for people who need a real plan, not a one-size-fits-all answer. That's why we can't rely on guesswork or shared formulas. Here are the 3 specific steps to protect what you've built. Let me introduce you to John. 62 years old, single, about $750,000, sitting in a traditional IRA. Good saver his whole career. And when he retired early, most people in his position would have done nothing. Just let the money sit, let it keep growing, and deal with taxes later. John did something different. First, recognize the window you're in. From the time you retire, usually somewhere between 60 and 65, until the year your RMDs begin and your Social Security kicks in, your taxable income is often at its lowest point in decades. No paycheck coming in. No mandatory withdrawals yet. If you're living off savings or a small pension, your tax bracket might be surprisingly low. Some planners call this the golden window. It doesn't last long, and most people miss it entirely. John was in that window. And instead of doing nothing, he used it. Step 2 is Roth conversions. Done deliberately, not all at once. Each year during his golden window, John converted exactly $30,000 from his traditional IRA into a Roth IRA. Not $31,000. Not $29,500. He calculated how much room he had left in the 12% bracket for that year, and he filled it to the ceiling, not $1 over. He paid the taxes on that $30,000 at 12%, in cash from his savings. That part stings a little. But here's what he bought with it. Every dollar in that Roth account now grows tax-free, comes out tax-free, and never shows up as income on his tax return. No RMDs either. Roth IRAs aren't subject to required minimum distributions during the owner's lifetime. By the time John hits 73, his traditional IRA balance is meaningfully smaller. His RMDs are smaller. His Social Security is less likely to be pushed into the 85% taxable zone, and his Medicare premiums stay in the standard range. He didn't earn more money. He just moved money at the right rate, at the right time. Step 3 is staying on the right side of the IRMAA line. The IRMAA thresholds for 2026 are based on your MA-J from 2024. For a single filer, the penalty starts if your income exceeds $109,000. For a married couple, it's $218,000. Cross that line by just $1, and Medicare adds $81.20 per month to your Part B premium. That's $974 per year per person for crossing a line you might not have even known existed. This is why the size of your Roth conversion matters. If John converts too much in a given year and accidentally pushes his income over $109,000, he's just handed Medicare nearly $1,000 for nothing. The precision isn't perfectionism. It's the difference between a well-timed move and an expensive mistake. Now, the honest trade-off. To do Roth conversions right, you need cash on hand to pay the taxes today. You can't just withhold from the conversion itself without creating its own tax complications. So you're spending real money now, money you could keep liquid, in exchange for a lower tax burden later. If you don't convert, you keep the cash. But your IRA keeps growing, your future RMDs get larger, and eventually that money comes out at 24% or higher, stacked on top of Social Security, stacked on top of whatever else you're receiving. Plus or more on top of that, year after year. Paying 12% now to avoid 24% later. The math is simple. It's just uncomfortable, spending cash now for a problem that feels far off. Paying taxes today at 12% to avoid paying them tomorrow at 24%. That's not a sacrifice. That's a purchase. Picture two neighbors, both 75. Both retired around the same time, both had similar savings going in. They even live on the same street. One of them, call him Dave, never touched his tax strategy. Figured he'd deal with it when he got there. His traditional IRA kept growing through his 60s, which felt good at the time. Then the RMDs started. Then Social Security on top of that. Then the Medicare notice. Now, every year, a significant chunk of what he saved disappears into taxes and premiums before he ever sees it. He's not broke. But he doesn't have much flexibility either. He talks about it at every neighborhood barbecue. The other neighbor, call her Carol, spent a few years in her early 60s doing Roth conversions. Paid taxes then at lower rates using cash she'd set aside. It wasn't painless. But she did it methodically, year after year, until a meaningful portion of her retirement savings was sitting in a Roth account. Last spring, her granddaughter got into college. Carol pulled $50,000 from her Roth IRA to help cover tuition. That $50,000 didn't show up as taxable income. It didn't push her Social Security into a higher taxable percentage. It didn't trigger an IRMAA surcharge. It just moved, quietly, without consequence. Same amount of money, completely different experience. That's the difference between a fragile plan and a resilient one. The fragility path isn't reckless. Dave saved diligently his whole career, but he handed the IRS the authority to decide when his income shows up and at what rate. The resilience path is about buying back that authority while you still can. What Carol bought herself is optionality. She can take money out or leave it. She can give it away or let it grow. She can respond to whatever life throws at her. A medical bill, a family need, a market dip, without every financial decision triggering a tax event. That freedom has real dollar value, even if it doesn't show up on a balance sheet. I don't have a crystal ball about what tax rates look like in 2035. Nobody does. Congress could raise them. They could lower them. The current individual tax cuts from the 2017 Tax Cuts and Jobs Act are scheduled to expire after 2025, which means rates could shift in ways that make today's 22% bracket look like a bargain. But I can't promise you that. What I can tell you is the math of right now. And right now, paying 12% or 22% on a Roth conversion is a known quantity. The alternative, letting a large traditional IRA compound for another decade and then pulling it out under whatever rules exist then, is not. In finance, having choices beats being cornered. Every time. The control is yours. But only if you act while the window is still open. Here's the thing I want you to walk away with. Retirement taxes aren't really about how much you saved. You could have $2 million in a traditional IRA and still end up with less flexibility, less income, and more stress than someone with half that amount who planned the withdrawals carefully. The number on your statement is not the whole story. The story is when that money comes out, in what form, and what your filing status looks like when it does. It boils down to three things: timing, form, and status. And those three things interact differently depending on whether you're married, single, divorced, or widowed. The same income that's manageable for a couple filing jointly can push a single filer into a completely different tax bracket, a different Medicare tier, and a different experience of retirement, even if the dollar amounts are identical. The system wasn't designed to be unfair to people who are on their own. It just wasn't designed with them in mind at all. So if you're single right now, or you've recently lost a spouse, or you're married but want to make sure your partner isn't blindsided if something happens to you, your plan needs to be built around your actual situation, not a template, not a general rule. Your filing status, your income sources, your specific thresholds. The moves we talked about aren't that complicated once you break them down. Recognize the golden window while you're in it. Use Roth conversions to move money at lower rates before RMDs arrive. Watch the IRMAA line the way you'd watch a speed limit, because going $1 over has a real cost. And understand that every dollar sitting in a traditional IRA right now is a dollar the IRS will eventually have a say over. The question is whether you negotiate the terms now or let them set the terms later. Look, this system is complex. I won't pretend it's not. But complex doesn't mean you can't manage it. Once you understand the rules, the actual rules, not the simplified version that gets passed around, you can work within them. You can make decisions that give you options instead of closing them off. That's the goal, not perfection. Just options. Take a breath. You haven't missed everything. If you're in your early 60s, you may still have a solid window to work with. If you're closer to 70, there are still moves available. The worst thing you can do is assume it's too late and do nothing. What's the biggest tax concern you're carrying into retirement right now? Leave it in the comments below. I read every single one, and sometimes the questions down there turn into the next video. If this kind of planning is what you're looking for, real numbers, real thresholds, built for where we actually are in life, subscribe to Wes Investor. No guesswork. No generic advice that doesn't account for your situation. Just the stuff that actually matters for our generation. See you in the next one.